Morning. I'm going to start by inviting you to introduce yourselves, and I'm going to start on my right-hand side, Nigel.
Thank you. Good morning. My name is Nigel Tarrington. I'm the Chief Executive of Paragon Banking Group. I'm also a board representative of UK Finance.
Okay, thank you.
Good morning. My name is Brad Fordham. I'm the Mortgage Director for Santander UK.
Thank you.
Morning. Charlotte Harrison, Interim CEO of Home Financing for Skipton Building Society.
Thank you.
Andrew Assam, Homes Director at Lloyds Banking Group.
Thank you.
Good morning, Henry Jordan, Commercial Director for Home at Nationwide.
Thank you. And obviously, as part of my work as Chair Outreach, I have had a dinner with the Building Societies Association, I think last week, and I think there was a representative from Nationwide there. I'm not sure anyone was there from Skipton, but I'll just step that out for the record. In terms of initial questions to each one of you, it's obviously been a long period where a lot of your customers have enjoyed very low rates on their mortgages and now have seen very, very sharp increases in mortgage rates. Can you share with the committee what you're seeing in terms of the reaction from those borrowers affected and how that's affecting the quality of your mortgage book, pointing out any increases you may be seeing in arrears, the number of accounts that you have in forbearance, and whether you're seeing a sharp increase in terms of any repossessions. And I'll start this time with Henry.
Thank you. So yes, agree that there is a significant increase in rates for customers maturing off their original product. As context for our mortgage book, it's around a £235 per month increase. That's roughly about a third increase in their payment. That said, we haven't really seen any real material movement in our arrears performance. Certainly within our prime residential portfolio, arrears are stable. We've seen a roughly a 1 basis point increase in arrears over the past 12 months. That's on a 3 months in arrears measure. We have seen a slightly higher increase in early arrears, particularly on the buy-to-let book, mainly because those customers are predominantly on interest only already and therefore have fewer options available to them. In terms of forbearance, that's actually down slightly year on year. So I think customers are generally taking action. That we have seen an increase in overpayments, we've seen an increase in term extensions, but no material increase in arrears yet.
Nationwide has pretty significant market share, as does Lloyds. Do you recognise the picture that we just heard there from Henry? What are you seeing? Because UK Finance data for the first quarter of this year did show a tick up in terms of mortgage arrears. What are you seeing?
They're very similar to Nationwide. So undoubtedly, households and customers are feeling the effect of not just mortgage rates increasing, but the wider cost of living crisis. But as we look at the impact on arrears, on forbearance and repossessions, very similar to Henry, you saw an uptick, but arrears remain very low in a historical context and still below what we would have seen pre-COVID.
Okay, and Skipton?
A similar story to tell. So in terms of the trend for customers, percentage of customers that are in arrears, that remains flat year on year. We haven't seen any uplift. Just referring to your point on UK Finance data and Q1 seeing a small uplift, I think what we've seen is some seasonality and trends in customers entering arrears. So we did see a modest increase in Q1. Arrears have actually come back down since then. So some of those factors sometimes are around seasonality of holiday season, Christmas period, and we tend to see an uplift in January. We also had the shorter April month bank holiday, and so some of those factors will play into arrears performance. But actually the trend over the longer term is that we've seen small uplift and then that trend has come back down.
Very interesting. Santander?
So very similar picture, a small tick up in arrears, still 20% below pre-pandemic, 70% below 2009 post-financial crisis, so relatively low levels. Similarly, in terms of payment increases for customers typically coming off 2.3%, and this year going on to an average rate of around 4.5%, with a payment increase of over £200 per month. Obviously, as interest rates increase, then that payment increase can increase. So a broadly similar picture. I think one thing just to probably point out is over the last 10 or 12 years, and certainly for us at Santander, 95% of the customers that have joined us as mortgage customers, we have stressed their affordability and understood can they afford the mortgage payment today, but also in the future. So we've affordability stress tested at a higher interest rate. Typically in the market that may have been over recent years around 6%. So at the time of application, or stress at the time of application, we've understood that customers can bear a higher interest rate, and that seems to be bearing out at this moment in time.
That's very interesting. Now, in terms of Paragon, your business mainly buy to let. Is there a portion of your business that's not buy to let that you'd want to comment on in the context of what you've heard your colleagues say?
The business that we don't do that's buy to let we are quite active in financing house builders, also small businesses as well. Our comment and observation there is actually we're seeing very stable arrears positions across all of those portfolios. In terms of, you'd like me to comment about buy-to-let specifically?
I think we'll get to some more detailed questions on buy-to-let as we go down, and that's very interesting. We're also doing an inquiry on small business lending, so it's interesting to hear your evidence on that. But if I can now start asking the question sort of in a slightly different way, which is around the provisioning that you're likely to put in place in terms of your loan losses this year. So we're coming up to reporting of second quarter results. I appreciate you won't be able to share anything that's not out there in the public domain, but are you going to be provisioning to reflect what you've just told us about the quality of your mortgage book? Bradley?
So I don't have specific numbers to hand. Of course, we're in a closed period currently. We would expect provisions to rise very slightly in line with arrears as customers move into different stages for reporting purposes. So we'd expect a small increase, but I don't have those. But happily, of course, can share with the committee in writing once those figures are available.
Thank you. Charlotte?
I would echo Bradley's comments. So I think provisioning will reflect the quality of our book. Again, would expect a small increase in that, but it's reflective of the position of arrears performance to date.
Okay. And Andrew?
We report in 2 weeks' time, so obviously in a closed period, but similarly the provision will reflect the underlying quality and arrears that we're seeing in the portfolio.
Okay. And nationwide?
Yeah, I can provide a bit more detail. I should have said, like Santander, our arrears rates remain below pre-pandemic levels, so we haven't really seen a material movement in arrears. We have applied some model adjustments to reflect borrower affordability impacts, which did increase our provision in our full year results, which are published in April. Our provision coverage ratio is 0.14%. That's more skewed towards buy-to-let than residential.
Okay. And then in terms of looking ahead to the second half of the year, it's been reported that there are a lot of people who took out 2-year fixed rates and that those will be coming to an end, and they took out those 2-year fixed rates when there was the stamp duty holiday to reflect the pandemic conditions. And do you model what you've got upcoming, and do you think that the picture that you've painted for us today is going to change markedly if we see you again in 6 months' time? Who wants to start with that one?
I'm happy to start. So I think there's a few drivers around the performance of book for customers entering financial difficulty. So Bradley's touched on some of them, which is around we stress test customers at a higher interest rate environment. So we stretch affordability in that assessment to ensure that we're future-proofing to as much as we can that the customers can maintain and afford those repayments. We also know that for customers that will mature this year, whether or not that's from a 2-year fixed period or a 5-year fixed period, they've been, for the most part, been making capital repayments against that, so the balance will have been reducing over time. We also know that we've just come out of double-digit house price growth, and therefore, whilst those customers have been repaying the capital balances on their mortgages, they've also benefited from movements in HPI and therefore afforded more equity in the properties. So I think what I expect to see over the next 6 months is that we will see more customers with financial stress, but I expect that to be relative to the market, and I think there are options available to those customers as well. And so customers that are experiencing financial difficulties at maturity, that's when we explore to understand what kind of forbearance measures may be appropriate or not for different individuals. So I think I would expect in this higher interest rate environment that we see more financial stress than we have done to date. But I also understand that will be spread quite differently across households and will be felt differently across households.
Anyone want to say any different to that? Bradley. And then I'll come to Andrew.
Thank you. So again, just in terms of the payment increase, I think it's important to recognise what that means for customers. So currently mortgage rates are somewhere between, in the market, say 5.5 to 6.5, obviously depending on lender. At 6%, the payment increase for customers coming off a rate of circa 2.3% is £350 per month increase. So it's significantly more. So in this environment, you'd expect, therefore, to Charlotte's point, that you would expect customers or more customers to have some financial difficulty.
And Andrew?
I was just going to a couple of builds. So we've, similarly to everyone else, we obviously stress test customers to make sure they can afford a much higher payment than they would be paying today. We also allow customers to lock into a rate 6 months ahead of their product maturing. And that gives them options to not only just lock in a rate today, but to start planning for that higher rate 6 months ahead. So it does give customers some opportunity to start planning if they've got an increasing rate coming down the line. The other thing that I would say is that historically, mortgage arrears have been highly correlated with unemployment. And undoubtedly, the cost of living crisis and inflation is really challenging. But while unemployment is still low, that obviously provides people with options, and finding different ways to manage their payments is challenging, but they still have, unemployment is still low.
Thank you. Well, I think that moves us nicely into the subject of the Mortgage Charter. Rushanara.
Great. Well, good morning and thank you. So I wondered if you could quickly run through how much of an impact you expect the Mortgage Charter to have. Who would like to start? From the left.
Yeah.
Henry.
Be seen, I think, is the honest answer. So we saw a really high take-up rate of payment holidays during COVID. A different option, a different period as well. Put that into context, we saw over 25,000 people take a payment holiday in the first few days of the option being there in March 20. 100,000 in 2 weeks and over 200,000 over the duration of the availability of those options. So that kind of gives a bit of a benchmark. I think it's hard to fully say what the take-up rates will be. My personal view is it'll be lower than that. I think the key change that we're seeing, so actually perhaps put it into context, all the options in the Mortgage Charter are available today, including an interest-only concession, for example. The key change is those options, particularly interest-only concessions, will be available without affordability assessment and without an impact on credit file. So at the moment, we see about 100 customers a month taking that option. But we know the credit file impact is a barrier to people taking that up. So that gives you kind of like the range that it could be. I think the important component that customers need to understand is that if they do take an interest-only concession for 6 months or they extend term, they will ultimately pay more interest.
It's cost lower.
So that's something that we're including within the application process for those options. And so probably the message from me would be really only take these options if you need to, because there will be a long-term cost.
Okay. And you were sorry. If everyone else could, if there are things you want to add to the point that Henry's made, that would be helpful. Andrew and Charlotte.
I was going to say, I think we welcome the mortgage charter. We think it's helpful for consumers and customers to have a clear idea of what banks will offer them. And I think this provides that. Similarly to Henry, we provide a number of these options for customers already. So I mentioned the opportunity to fix 6 months before maturity. But it does provide consumers and customers with a deal of clarity on what they can do and can expect from their lenders.
Charlotte?
It's a build on that point. So I think in terms of level of take-up and customers seeking those options, yes, remains to be seen. And to Henry's point, I would also expect that will be lower than what we saw with payment deferrals during the pandemic. I think, touching on one of your points, Andrew, around customer certainty, it is a different environment that we're in today. There was very little certainty during COVID around what that meant for finances, what it meant for employment and work, and what customers understand now is what that certainty of payment might look like over the next 12, 24 months, and the options available. So I would expect it to be lower, but we're also equally preparing for customer inquiries coming to us.
Bradley and Nigel, did you have anything to add to those points?
One point to add would be what we've seen most recently, and it's a point that Henry raised, is customers who have a mortgage product that's expiring over the last few months, less than 4% of those customers are inquiring about a mortgage charter type solution, obviously pre-mortgage charter, but a term extension or a conversion of their mortgage to help affordability. So again, to Henry's point, we would expect the numbers to be lower than the pandemic in terms of the payment holiday situation. But again, yet
more likely to extend terms, the length of the repayment.
Yeah, I mean, I think it would depend on the customer circumstances, and what we would encourage customers to do is to contact us as lenders to talk through those options and understand all the options before they decide. Because if a customer can afford the increased payments, then longer term it's better for them because they'll pay less interest, of course.
Nigel, anything to add?
Yeah, the mortgage charter, we're a specialist buy-to-let lenders, but the mortgage charter does not apply to buy-to-let. However, we are following the charter itself, and we would be very happy to sign the charter if we were required to.
I mean, should you be included? Because the evidence suggests that it affects there's distress in that sector as well.
Yeah, so I mean, I don't know why buy-to-let was excluded, but we're very happy to sign the charter.
Could I make a comment on that, please? Sorry. I mean, the options around extending term or moving to interest only, a high proportion of buy-to-let customers are already on interest only, so those options don't really apply in that situation. I should also mention
the length of extension. Sorry, the extension, does it apply to, they can already do that?
Wouldn't make a difference to an interest-only mortgage either.
Okay.
I should have mentioned that we already offer the option for customers to extend term out to retirement. We see between 800 and 1,000 of those applications per month. That doesn't have an impact on credit file, no affordability. So perhaps a benchmark of that sort of take-up going forward.
So what is the point of the mortgage charter then, if you're already doing much of what's written up? Is it that just people know a bit more about where they stand and it's in one place? Has the Chancellor added anything in substantive terms by coming up with this mortgage charter?
Sorry. I think it provides consumers and customers with clarity around what's out there and consistency. So different lenders would have had different approaches. So I think it does that. I also think that inflation is still high, so there's still the ongoing squeeze for customers and consumers. So I think it's helpful intervention if things as things progress.
So 85% of the market is covered by this voluntary charter, according to one report. There's 15% who are not. Do you have a view on whether the government should reach out to them and encourage them or kind of try and influence them to sign up to this charter? I think these are those it would be appropriate for them to sign up. Given you think it's quite a good thing. Anyone?
I think each lender will have its own reasons if they aren't signing to the charter, and it may be, to Nigel's point of being about a specialist lender. I don't know. Just from a Santander perspective, we're supporting the charter and signing up.
Okay, and so what we know in terms of overall figures is that we're going to see 1.4 million households that are set to roll off fixed rates over the course of this year, and as the chair has said, most of them have 2 to 5 year, 2 years up to 5 years ago, and we're on much lower rates. So we are going to see much more stress in the system. What do you think you could be doing above and beyond what's there in the mortgage charter and what you've been doing to try and minimise the risk of repossessions or distress, even if they don't face repossession? It's going to cause a huge amount of financial distress if your mortgage, average mortgage in London is going to be go up by over 5,500. Nationally, it's just under 3,000. Have you got a view on what more banks can do? Andrew?
If I outline the way we've thought about it and what we're doing, that might help with some context in the way that we're thinking about approaching this. So there's largely three groups of customers. There's those customers that are coming off fixed rates, and for those customers, we allow them to select a product 6 months before that maturity again. So that allows, as I said, that allows them to plan. We've also looked at within there what customers are at potentially high risk, and we phone those customers to not only allow them to lock in, but also to an extend term if they need to. So that's on that group of customers rolling off those fixed term products. So we try to help those customers, and for those most at risk, we are proactively reaching out to them. Then there's a group of customers on variable rate products. So for those customers, every single customer gets at least one communication a year that tells them what other products are available. If you can make a saving at all, we'll send you another communication and tell you can make a saving by moving to a different product. So for example, if you could save £100 a month, we'll say you can save up to £100 a month. So we're really explicit in that communication. And again, for those customers who think are at most risk of cost of living, we do outbound calling. And we've called 35,000 customers to let them know that there is the potential for another product to move to. And then finally, there are customers in financial difficulties, and we've got a suite of tailored forbearance activities for those customers to try and keep people in their homes and only use repossession as a last resort.
Does anyone else want to add?
Yes, just an additional point is we use quite an extensive suite of early warning indicators. Yep. So if you wait until a customer has not paid, then our view is always try and anticipate that and deal with it early. Mm-hmm. So we use everything from obviously listening to reaching out to customers in a similar way as described by Andrew, but also we use a lot of quite smart technology to try and identify early signs of stress in an individual's life that may not be evident yet in their payment performance. And if we do see that, we reach out to the customer and try and understand the issue and then offer help where it's needed.
Just finally, do any of you know about mortgage prisoners and what the implication of the rising interest rates are going to be for them? Do you have people who are trapped in the mortgage prisoner kind of category? And also, how do you have a view on the fact that the extension of mortgages or the break, if you like, does mean that the overall cost burden will be pushed back to later on in life? And what are your thoughts on that? Because people are still going to be worse off. It's just about deferring the pain, if you like. Any thoughts on either of those points?
Pick up the second point. So people extending term now, for example, to manage their payments, when they come to renew their product in the future, it may be that the rates have reduced at that point. As part of the product switch journey that we have, we encourage people to review their term again then. So at that point, when rates have come down, potentially they can reduce down their term and therefore reduce the total amount of interest they pay.
They'll still be worse off than...
They'd have incurred more interest during that initial period, but the earlier they do that, the less they
Any other comments on either of those points?
Just on the mortgage prisoner front, from a Santander perspective, we offer rates to all our customers. So there's no customers, it's similar to Andrew in terms of the contact strategy for customers on variable rates, so that they are aware of other products that they can fix onto if that's what they prefer. We have 90% of our customers at the moment in fixed rates and only 10% in variable.
And the affordability changes that we push for in this committee from absolute to relative test for those who are trapped in as mortgage prisoners, is that have you used that as you've done the assessments?
So I know there's a second piece of work underway at UK Finance to look at mortgage prisoners, and particularly to try and understand the data better from those closed book lenders, so we can tailor our approaches, and that work is ongoing currently with UK Finance.
You do know that I've been campaigning on this for years. In this committee, the FCA had revised the guidance from an absolute test to a relative test of affordability. We were assured that things would then change and people would be able to have access to mortgages and favourable rates and be able to switch, and it seems very slow, the work that's got underway. One of you is on the FCA board to get this going, and now people are stuck in this situation with rising interest rates, so it's going to be even worse for them. Can we have some urgency, please?
Just to comment, we have no mortgage prisoners on our portfolio. Every customer can get a front book rate, and we have adjusted our affordability for mortgage prisoners. We see very little coming through. But when we looked at it previously, we did see that there were a number of customers applying to us from closed book lenders, but not necessarily categorising themselves as mortgage prisoners.
Very much.
Thank you very much.
Thank you. And just in terms of the mortgage charter, you're going to be subject to the consumer duty from the end of July. Do you see any contradictions between what you're being required to do by the consumer duty and what you're being required to do as signatories of the mortgage charter, or do you think they're completely aligned? Anyone want to answer that one?
The key point for the charter is around the customer awareness and understanding, and that's the key component to make sure that when customers are choosing to temporary move to interest only or a term extension, that it's really clear up front that there might be cost implications, what those cost implications can be, and if the customer then chooses and is comfortable with that to proceed, and that's okay. I think that clarity is where it's much needed, and that's the process that we're currently working on now to make sure that we've built that into the processing, so customers have a real awareness of what that means in terms of the longer term financials.
And Lloyds and Santander, you both mentioned that you're contacting customers proactively about a lot of this. Yesterday we heard on our campaign as a committee to increase savings rates. One of the reasons banks were not increasing savings rates is because they couldn't contact their customers to tell them that higher savings rates were available because of restrictions around GDPR. So we think that's a very implausible excuse, and we would just like you to feed that back to your employers. Douglas.
Yeah, thanks very much, Chair, and good morning. Can we just start with a quote that I've got from Citizens Advice Scotland that says 11 to 14% of people can't make it to the end of the month on their pay due to a combination of the cost of living, energy costs, and now with mortgage increases. I think, Henry, in your opening question, you said that you're not seeing a huge spike in level of debt, and I think that was echoed by other members on the panel. I'm just wondering, what level of mortgage do you think you'll begin to see a spike in maybe underpayment or no payment being made towards people's mortgages, given the pressure that is on households?
It's hard to give an exact rate. It would be different for each individual.
Well, one high street bank that I've been talking to said that once rates get maybe to 7%, that's maybe the cut-off point where they would see an exponential rise.
So the increase I referenced at the start, the £235 a month, is assuming a 5.5% pay rate, and coming from a sort of 2.25% pay rate currently. We talked about the impact of the mortgage charter. Extending term would reduce that increase to about £134 a month, so it takes about £100 off that increase. If they convert to interest only, they could move to a a lower payment than they have currently. So even though their rate will increase, moving to interest only will more than offset that increase. And that remains true until you get to somewhere between 6.25% and 6.5%. So that might be a kind of tipping point at which options like interest only won't be sufficient to offset the increase in payments that the customers will see.
Andrew, do you have any comment on that?
Nothing other to build other than to say I think the fact that unemployment remains low means that although there is definitely a real challenge for households in terms of spending, there are still choices that the customers can make to try and stay in their homes, and we support them in that through things like Henry's outlined with move to interest only and term extensions.
Yeah, so some of the options that you can offer customers are even to add changing the balance between interest and capital repayments every month and interest only, and if there's some form of holiday that they could take in terms of overall. But maybe Charlotte and Bradley, what would you think? I think people are trying to find ways of paying all these bills and dealing with inflation and all the other things they've got to deal with at the moment. So what do you think is the source of people's income in terms of trying to, well, not the source of income, but what are they using to actually pay their mortgage and find these other bills? Are you seeing any trends in terms of maybe people using up savings, or what are the percentages of people who are actually moving to a different term or changing the conditions of their mortgage? Because it's all very well saying, we're seeing people, or the people have got options to do that, but if we understand the trends and how many people are actually doing it, then that might be quite useful from the committee's perspective as well.
And so from Skipton's data, to date, we aren't seeing a material uplift in customers choosing those options or requiring to choose those options.
Right.
So our customers that are entering into arrears has remained consistent, so we're not seeing an uplift in that. We also know that within the data, when we're talking to customers that are experiencing financial difficulty, that is more driven by life events rather than the rate environment. So that's still illness or unemployment. But I suspect that when we see higher rates, we will start to see more of an uplift of customers choosing these options. But we're not seeing that today.
Yeah, so a similar picture for us at Santander. I think we are seeing some customers, and you see from bank account customers and the turnover data and understanding the data there, you do see some customers that are looking to cancel subscriptions and that sort of thing, which would be an early sign. We don't see any particular deterioration in our unsecured customers who have unsecured debt, so it doesn't seem to be at this moment in time any lead indicators that they're struggling to pay there. I think from our perspective, we're just looking to support our customers and the customers that have, similar to other members on the panel. We've contacted 1.8 million customers this year, targeted outreach to those customers, again, that we feel are at risk potentially of having financial difficulty, encouraging them to contact the bank to discuss any issues they have and for us to support them. Again, similarly, we have a range of measures in place to support those customers through that period.
Okay. What about new customers as well? To what level are you stressing their interest payments and general mortgage repayments if they're new customers to the bank or the building society?
So similarly, in terms of what we've done previously, we still stress mortgage customers their affordability at a higher rate than the pay rate. Mm-hmm. So typically that might be dependent on the customer, but it may be 2 or 3% above their pay rate. But typically in the market, lenders will be stressing at this moment in time somewhere between 8 and 9% pay rate to ensure that customers have future affordability.
I think, could I just add as well, another component of that is that when we look at affordability, we'll look at interest rate risk and stress test for that. We also will look at expected household expenditure, and so what these customers, what's new customers to lenders, will also be undergoing a full affordability assessment, which assesses both elements, and so that will factor in current inflationary costs and what it costs to run a household as well. So that will be factored into an affordability assessment.
Right. And are you any And in terms of Skipton, for example, you seeing any increase in the number of rejected applications on the basis of affordability?
So we're not seeing that in our data currently in terms of decline rates. However, what I would say is that 90% of customers that come to the society are introduced via a broker, and brokers will run an affordability assessment up front. So whether or not they're seeing a variation in that data, it would be in the intermediary market where they're seeing where you would or wouldn't accept cases. But once they're placed, we're seeing a similar level of accept rate.
Right, okay, and is it the same with Lloyds and Nationwide, would you say?
It's exactly that point. Brokers will kind of filter the applications. Our accept rate is steady around 80%. The other thing we would be seeing is perhaps borrowers, particularly first-time buyers, maybe saving for a bigger deposit or buying a slightly different property. So I think that, there has been an impact on affordability. We have a two-tier approach. So our standard affordability is stressed at just under 9%. It's there's rules around your revert rate plus 1% that drive that, where we specifically target our extra support for first-time buyers. So whether they take a 5-year fix or longer, you can apply a different view of stress rate. So we apply a lower stress rate in that situation to try and support first-time buyers through this period.
And you seeing, Andrew, any are first-time buyers still involved in the market? Are they still coming forward to actually purchase new properties or get to the market?
We Lloyds Bank Group do around 1 in 5 first-time buyers, so it's an important part of the market for us, one that we're really committed to. The market is smaller in 2023 than 2022 because 21 and 22 are very, very large years due to the race for space post-COVID, where people, change their living habits and living styles, and then you have the stamp duty holiday, so that drove 2 very big years. So it's sort of understandable that the market this year is going to be smaller than those 2 years, and it's more aligned to 2019. So yes, it's down, but it's more normalised in its size. There's still but within that, first-time buyers have also reduced, as you'd expect. But people, as Henry said, people are either putting down a larger deposit or buying a smaller property because affordability is tighter. We won't lend people as much now with rates at where they are as we would have done historically. So yes, people are moderating what they can afford to buy.
And because of that, are we seeing any changes in, I mean, it might be regional, but any changes in house prices?
Yes, we published house price index, so you can see it's a moderation in house prices, but again, it's small. And I think in our Q1 results, we said that we expected them to fall around 5% this year.
Okay. Maybe can we move on just very quickly to the buy-to-let sector, Nigel, as well, and just to see what changes you're seeing within that sector and whether you're experiencing lenders or whoever actually stress testing anybody who wants to move into that sector at the moment, although I know there's a lot of issues around the sector as a whole at the moment, but I just wondered what your view was in terms of buy-to-let and where that sits at the moment.
Yeah, so stress testing applies equally in buy-to-let. The model is different because you have rental income as opposed to normal employment income to consider. But the industry and we do employ stress tests in order to assess whether the affordability is achievable, not just today but at higher interest rates as well. They will vary depending upon the customer and the customer type, whether they are a single property landlord or a multiple property landlord. Equally, also depends on the tax rates as well. So it's a little more complicated, I think, than the owner-occupied market. However, what we have seen more generally is there is certainly a weaker level of demand out there, which is probably not surprising given general trends in the economy, the housing market, and the like. There's also perhaps a tendency for individuals to stick with their existing lender a little longer. So they stay on the books and take a product transfer, so take another fixed rate, but within the firm as well. And what we also have seen is the kind of the changing dynamics within the wider buy-to-let market, or the wider private rented sector, where demand for rented property remains very strong. It's very strong. And, you know, I'm sure at some point you'll want to talk about what's happening in the rental market. But what you see is that the affordability tests that we establish are, typically you want something like a minimum of around 150% rent to debt service coverage ratio. So you've got a buffer to allow for increases in interest rates and increases in costs to manage those properties. Typically, we're running at around 200% now, so you've got capacity to absorb those higher interest rates and costs in managing the properties as well.
Is there any concern within the sector just now if you, I think you said earlier that a lot of the buy-to-lets are on an interest-only basis, so in terms of maybe falling house prices and the capital that you might have invested into a property, is that a concern within the sector as well?
Yeah, so I think there is a certain perception around buy-to-let that it is a riskier product. I would dispute that. Actually, I've probably built a career out trying to dispute it. I've not necessarily succeeded. But if you look, the average loan to value is 62.5% on our portfolio. It's very different to what life was like before the financial crisis. But you know, our loan to values are not untypical of the industry as a whole. And one of the reasons why lenders don't typically do much more than 75% loan to value is because actually you want to ensure that the investor, the landlord, has got an investment in the property. It's not the roof over his head, but you want to make sure that he is invested in the property. So typically the maximum loan to values you will do will be lower. And that is very much, it's not just a Paragon thing, it's across the industry as a whole.
Just to echo that from a Skipton Group perspective, where we've got Connell's Group estate agency and letting arm, we see the same trends. So I think 70% of the buy-to-let properties are mortgaged, 30% aren't. And of those that are mortgaged, 90% of them are less than 70% loan to value. So there is a significant amount of equity in the property.
Yeah, the gap in that. That's right.
I'd also point out on the arrears statistics, again, the perception of buy-to-let being a riskier product. If you look at the buy-to-let arrears for the industry, they stand today at 0.43%. That compares to the owner-occupied market at 0.78%. So it's almost half the level. And you might think, is this just a one-year wonder? If you go back to every year since data was recorded, it has been the same. Buy-to-let has been a lower level of arrears than owner-occupied, with one exception, and that was 2009, which clearly we all remember what happened, but that was largely created by Bradford and Bingley. Their arrears stood at 6%. You take them out, and you get back to the same trend line. So hence one of the points of why I think people misunderstand the credit standing of landlords in the buy-to-let market. The evidence actually points to it being much stronger than the perception.
Thank you very much. And we will be asking more questions on buy-to-let. And I'm sure, Nigel, that you would want to acknowledge that landlords can also be women and say he or she when you're referring to landlords. Anne-Marie.
Thank you, Chair. Can we now turn to the availability of mortgages? Douglas has looked at the affordability, but we've seen very volatile positions where rates have been offered, then they've been withdrawn, and there is a concern, I think, among many who want a mortgage as to at what point do they lock in. And for many, there is a question mark about whether they want fixed or whether they want some form of variable tracker-related product. So when you look at the availability of mortgages now, what are you seeing and what are you intending to offer in your portfolio? to reflect that changing demand of what individuals want, and your challenge with inflation and interest rates changing very, very quickly. And perhaps I can start with Bradley.
Sure. So, thank you. I think what we're seeing from a new availability for customers, and we've already touched upon it so far, is from an affordability perspective. Clearly, if you were a customer, and what we see typically for first-time buyers or people moving house is the first question they'll ask a broker, because 85% of the market of origination of new mortgages come via intermediaries. The first question they'll ask brokers is, well, how much can I borrow? What's my maximum I can borrow? So they know when they go and view properties what their budget is, how much equity they've got, and therefore they have a price in mind. What we're clearly seeing now, in terms of the way we stress affordability, and Charlotte's point around the fact that customers' general bills are higher, food and fuel, etc., means that customers, for their maximum borrowing, is less than what it was a year ago or 18 months ago. So clearly that's going to constrain customers' choices and what properties they can afford. And again, to Andrew's point, we can see some signs where customers are either putting more deposit down or looking for a smaller property. From terms of availability of products, I think we are seeing it's been a very volatile period. Base rates have been increasing, swap rates have been increasing, which is generally the funding cost for banks, and therefore there have been price increases by lenders. We are super conscious of that, and actually what we do is give brokers notice in advance that our products will be changing. So if products are being withdrawn and new products launched at higher rates, it gives brokers the opportunity to book those rates for the customers before they're withdrawn, before they're changed, so that customers have at least some option of, right, okay, I know this is the price today, maybe that's changing tomorrow, we've given notice, and therefore the broker can book that. And similarly to Andrew's point, for existing customers, we allow customers to pre-book their rates. We write to them before their deals mature, and allow them to pre-book. And as part of the charter, although available before, customers then, we've committed to, if those rates go down and they have pre-booked a rate because their new rates are ending in 3 or 4 months, that actually they can change that rate and take the lower rate before their new due starts.
And the way you're talking leads me to conclude that you are still very much focused on a fixed rate type of mortgage arrangement rather than anything which is more flexible. And may I ask you, Andrew, do you share that view, or do you think there is now a demand for, and maybe an appetite on the part of the banks to look at that sort of product, or do you see that as high risk and something you're going to try and persuade borrowers not to look at?
So we offer 2-year fix, 5-year fix, 10, and we have a tracker product. So trackers were completely out of favour in the market for a number of years. And everyone went for a 2 or 5 year fixed. Post the mini budget, when there was volatility in the market, trackers became very popular, and we didn't have a tracker in the market at that particular time. So we introduced it in January to recognise the customer demand for that product. I think it's a helpful product for volatility, and I think it worked for some customers in October, November, because it was volatile and rates actually did come down. It allowed people to have the flexibility that a tracker offers. So we think we're offering a full suite of products that customers at this point in time would find useful and want. And the advice process that customers go through is critical in determining which product is suitable and appropriate for them.
Charlotte, can I ask you this? You earlier quite rightly referred to the number of owners that don't have mortgages. Do you see, as the cost of living crisis begins to bite, an increasing number of older people wanting to take out new mortgages? And do you see the sector beginning to address the issue? Because you've not only got individuals who maybe want to be borrowers, not for the first time, but again, as they get older, but also those who are already with mortgages, who are still working well into their 70s and 80s, who are still more than capable, because they are still waged, if I can put it like that, to repay their mortgages. Is that something which is being addressed in the structure of the mortgages which you're offering?
So, to your second point around lending into what would be retirement age, if people are working and able to evidence through regular income, we will lend in that space.
With no age barrier. If you're in work, it doesn't matter how old you are, you can still take a product.
Well, so we assess individual circumstances on that in terms of how far into what would be retirement, and if they can, and if there's evidence of income and that's sustainable, then yes, we would look at that for customers. The first point around customers that are currently mortgage free and looking to release equity from their property. The market exists today. It's not something that, in terms of equity release, it's not something that Skipton lends on. I think will we see that as a growing market potentially, and it may not actually be to service their own households, but whether or not we see more in terms of intergenerational lending as well, for people supporting sons or daughters or family as well. So that may be a growing market.
So Bradley, I suspect you do offer equity release. So do you see this as a growing way of people being able to manage their finances going forward? And is the original structure, which I think many saw as quite destructive because of the amount of equity that effectively went to the lender, but the market seems to be changing?
So we don't currently offer equity release via Santander brand. We have an arrangement with a third party where we refer customers over if that's the type of lending. We lend to age 75, similar to the Skipton, providing customers can evidence income up to that age and it's affordable for them. But if a customer wants lending past retirement, then an equity release type or later life lending, then we have an arrangement with a third party that we would refer them to so they can explore those options.
Thank you. Henry, first-time buyers. We've talked a little bit about first-time buyers and the availability of mortgages, and clearly they're buying smaller properties, and the relativity between the equity and the loan is clearly changing. But what sort of advice are you giving, and what sort of things are you offering to the first-time buyer? Because for them, they've got many years ahead of them, but it is an absolutely crucial decision to make at this point. Are you looking at evolving a different range of products, and what availability specifically are you looking at putting in place for the first-time buyer?
In terms of our product offering, that hasn't really changed. We've talked about obviously higher rates, but the range of products available is unchanged. I mentioned earlier our support for first-time buyers, so we have a specific proposition called Helping Hand, which lends up to 95% and up to 5.5 times income. As we said, trying to help first-time buyers through this period and ensuring that they can get onto the property ladder. In terms of advice around whether now is a good time to buy or not, that's not something that we would provide advice on. That's very much an individual decision, depends on their circumstances. So it's very much as we were in terms of offering, and as I think Andrew said, we're still seeing demand from first-time buyers.
Thank you. Nigel, buy-to-let. It is a very different market, and here I'm not looking at affordability but availability. There is a lot which has changed in that sector over the last decade in terms of tax treatment. We now have the Renters Reform Bill on the horizon, all sorts of things impacting that market. In terms then of the availability of buy-to-let mortgages, do you foresee any changes? Is it something that the sector is saying, because of all the complexity that's coming down the line, this is a product which we don't want to continue offering in the same volume as we did before?
I don't see a reduced appetite from the industry. I'd say the competition, as it were, is as intense as ever in that space, and I think there is plenty of capital available from the industry to support that market now and going forward. I think if anything, there might be a shortage of landlords. We probably see that most evidently through the shortage of the stock of properties available to rent, which has other consequences which we can no doubt talk about later. But I don't think there's any shortage of supply of funding or capital from the industry as a whole, whether it be specialist lenders. Is it more complicated? Yes, it is more complicated. We choose to focus on being a specialist lender because we think we deal with typically much more of our business is towards professional landlords. One of the things they have to wrestle with and deal with is 169 different forms of regulation and legislation, and they have to understand it, and they have to apply it. So we need to make sure we're experts at that as well in order to deliver the products and services to the customers at the same time. But it is more complicated for sure.
One final question I'm going to ask you, Andrew. To what extent do you think your sector is baking into its thinking the impact or likely impact of the current economic position on house prices? The prediction is that they are going to fall. Clearly that impacts your calculation in terms of the products you offer. To what extent and how are banks and building societies taking that into account in the way they structure their offerings?
So the place that this probably bites most is for first-time buyers that will be typically at high LTVs. I think Henry touched on this, where it's a completely individual situation, but we still think owning a home for most people is better than renting, and therefore we want to keep products available at higher LTVs for first-time buyers. But we need to make sure that those first-time buyers are resilient, i.e. they can afford to stay in their home through a 2-year period where house prices might be falling, for example, and they're aware that they could end up in negative equity. So what we don't want is customers being completely unaware of the risk of house price falls and find themselves in negative equity and find themselves vulnerable to unemployment, for example. So we're thinking deeply about who do we lend to and the disclosures that we make sure customers have about the potential for any house price falls. That's how we're thinking about that at the moment.
Thank you very much, Anne-Marie. Andrea.
Thank you. Good morning. You're all sounding incredibly reasonable and fair, and you all have excellent systems to support your customers. But I'd just like to put out there that I have a constituent who was ill and therefore couldn't, as a self-employed person, achieve his income, and was assured by his bank that as well as giving him a payment holiday, it wouldn't impact on his credit file. And so he accepted their offer, and it did impact on his credit file, and then he couldn't remortgage. So that left him in a very dark position. So hearing all that you're saying, there's a slight pinch of salt there, because as a parliamentary representative trying to get the bank, who I won't name here, to actually be fair to that constituent has not been possible so far. So I think it's always worth remembering that whilst you say you have the systems and you're reaching out to people if they are potentially getting into difficulties, that your systems don't always do as you wish them to. And so I do want you all to take that on board and give that consideration, and particularly when people do come to you with their particular cases. This, I believe, is being streamed live on the BBC, and so there will be lots of people sat out there throwing things at the television saying, this isn't my experience of borrowing money. So, complacency is just not an option in the current situation. I did want, however, to question you about house prices, property prices, and to understand, certainly, Mr. Jordan, I believe one of your colleagues, Chris Rhodes, told us last November that nationwide central scenario would result in house price falls of 8 to 10%, but potentially up to 30%. So could we please hear from each of you about what is your central forecast for house prices, and are you already experiencing negative equity, and how will you deal with homeowners who go into negative equity? Starting with you, please.
Thank you. So I think similar to Andrew's point earlier, we've already seen some fall in house prices, roughly about 4% from their peak in August last year. We'd expect some further slight falls to around about 6.5% would be our expected peak movement. Your question about negative equity, we have a very, very low exposure to negative equity currently. I think it's 0.1% of our book. So we're not seeing those movements in house prices really have any specific bearing. Sorry.
But if house prices drop 6.5%, what will that do to your negative equity?
It won't increase materially. So I think it's about 2.5% of our book above 90% LTV.
Right.
So there's headroom because of the house price growth we saw through the pandemic, and lending standards around higher LTV lending as well. From a customer perspective, again, as Andrew mentioned, if they go into negative equity and maintain their payments, that might be for a fairly short period and it wouldn't have any direct impact on them. Clearly, if they're having wider payment problems at the same time, that's where the other support measures that we've talked about would also kick in.
Thank you. And Mr. Assam, are you seeing any particular regions where there are more impact of negative equity or impact on house prices?
The region that's been most impacted is London, the South East at the moment, according to our index. And that's been a pattern pre the fall. So we saw the biggest increase in house prices where there was most affordability. And now we're seeing London fall, potentially because that's where affordability is obviously most stretched.
Sorry, can you expand on that a bit? So does that mean that London and the South East will suffer more as a result of bigger falls in house prices, or are you saying that there's more headroom in the affordability for consumers?
We saw larger falls in London
Yeah.
than in the rest of the UK.
And does that therefore mean that you are likely to see more families in negative equity and potentially more financial difficulty?
Not really. If you look at the LTVs on our portfolio is around high 40s, so it's very low. And the average loan to value in the portfolio again means that we don't expect to see large amounts of negative equity.
So essentially what you're seeing then is property prices went up faster and now have come back down again, so it's sort of less gain on the value of your property as opposed to a negative equity
That's
situation. Right, thank you. And Ms Harrison, what about Skipton's situation?
Similar view. So in terms of, again, from the estate agency arm, new instructions to the market, we're seeing about 2% reduction from to June last year, so on a year-on-year basis. Equally, the average loan to value of our mortgage book is around 53%. So a lot of customers have significant levels of equity in their products, in their mortgage. And equally, for those customers that come to rate switch and perhaps are in negative equity, which we're not seeing, but if that materialises, we have products available for them as well.
Right. And the same for you, Mr Fordham and Mr Terrington, similar situation?
Very similar. Our average loan to value is 51% for customers. We have less than 1% of our customers that have a loan to value above 90%. So again, in terms of impact of house price reductions would have a limited impact on negative equity.
That seems very low, 51%. That sort of suggests that you've not sold many properties recently at high multiples of income. Or is that because house prices have rocketed? Why is that so low?
The two things from a new business, so that's our existing customers who may have been with us for some time. From a new business perspective, it's closer to 70% LTV is our new business average loan to value. There's two aspects to it. One is obviously house price increases, but also most customers, 90% or so, take a repayment mortgage, and therefore over time they're paying their capital down, which therefore increases their equity as well. So you kind of get a dual effect.
But on the one hand, you're saying you're lending people large amounts against a property, but the loan to value is very low, so that doesn't quite stack up with new customers, does it?
So these customers have a range of LTV points. Our average for new customers is 67% LTV. There will be some customers that clearly we lend 90% or 95% to, but on average, and obviously some customers who have a very low LTV, who have more equity, who are possibly moving home rather than a first-time buyer.
And is that their choice, or are you forcing that upon them?
No, so again, similarly, we have a range of products up to 95% for our customers. You know, we rely on our advisors and also intermediaries to give customers advice to understand what's the best product for them. Be that availability of trying to put down a little bit more deposit. We see more gifted deposits now than historically for, customers who are getting help from family generally, parents or grandparents that help with deposits, which then can make the mortgage therefore affordable if they put more deposit down.
So, I mean, arguably the difference between now and the 2009 scenario is that people are perhaps more risk averse, less willing to take on a huge loan to value ratio themselves. Would you say that that's the case, or would you say that the lenders themselves have become much more conscious of affordability?
So definitely lenders are more conscious. There is regulation that supported that. So we talked about the affordability stressing above the pay rate, and also that from a lender, there's a PRA rule where you can only lend 15% of your new lending to customers above an income multiple of 4.5 times. So there is some regulation in play to make sure that it's responsible lending.
And would you say that therefore leads to the conclusion that that's what makes it so difficult for young people to get onto the housing ladder?
No, I think it's a number of factors that house prices, currently affordability is more difficult than what we've seen in the past, which we've touched upon. But I think it's ensuring that we're responsible lenders and making sure customers can afford mortgages both now and in the future, and I think that's the most important point.
And how are housing transactions holding up generally? Question to all of you, are we seeing a decline or an increase in house transactions as the value of them goes down a bit?
Housing transactions are down. They're probably off around about 20 to 25% from where they were sort of the back end of last year. I think is that
seasonal, or is that
I think it's probably been affected by the rise in interest rates. There was a disruption around what happened to the mini budget, but you've had a couple of years worth of high levels of distortion in the housing market. So if you go back to probably a time before disruption, like 2019, then you're still looking at housing activity lower today than it was in 2019. You had a big surge at various points during COVID, but it's still lower, and it's likely to remain lower this year, I think.
Right. And is there any change in consumer behaviour for new purchases? Are people looking for longer term fixes? Are they tending to stay on variable rate mortgages in the hope that interest rates will come down? Perhaps Mr. Assam?
We've seen customers take longer mortgages, so the proportion of customers taking mortgages over 25 years has increased. That's a way of managing. So
that's repayment terms. And what about the fixed rate aspect of that? Are they fixing for longer?
Yeah, sorry, that's what I meant. No, they're not fixing for longer. So the split between 2 and 5 year fixed has moved more to 2 years.
So they're fixing for a shorter period in the hope that interest rates will come down.
Yeah.
Right, okay. And are any of you offering longer term fixing, 7, 10 year fixed rates?
We offer a 10-year fix, and we've offered that consistently. And our 10-year fix is at a lower rate than our 2 and 5 year fix.
And are you all in the same situation? Are you all offering 7 and 10 year fixed rates?
Not 7 but 10, sorry. Not 7 but 10 year, yes. And we typically see very low take-up rates of that, sort of less than 2%, 2 to 5% on some periods. But despite the fact, as Andrew outlined, it's our lowest priced product, we see very low take-up still.
But you're not offering it?
Yeah,
so you would see, you are offering
we
7
offer 10 year but not 7.
Ah, okay.
Sorry.
And are you all offering 10-year fixed rates?
We're not currently offering 10-year fixed rates. We have in the past, and again, very, very little take-up.
Yeah,
right.
Same as well.
Same.
Okay, thank you very much. And then, are you finding that customers are shopping around for the best deal more often than they used to? Is there much more mobility of people choosing to refinance with a better, cheaper provider? Ms. Harrison?
I think we're seeing, to my mind, similar levels in terms of, again, I go back to point, 90% of our business that's introduced to us comes via a broker, so they will be always actively searching for the best deal for their customers. I think what we are seeing is more switching of products between point of application to the point of completion. So that is a trend that we're starting to see more of, that as we had interest rate movements within fixed rates, that people are choosing to switch to a different alternative closer to the time of completion if it's cheaper for them. So
okay.
That's a small trend that we're seeing.
And how easy is it to refinance with another provider once you've already got a mortgage with one provider? Is it still incredibly costly and difficult to do that? Mr. Assam?
No, I think it's easy. The market is highly intermediated, so lots of brokers, as everyone said, 85% of new mortgages go through a broker. The broker will find the right deal for the customer in a large case.
This is remortgaging. This is
Remortgage.
consumers saying, I don't like this mortgage provider,
I'll go
there's a
somewhere
cheaper
else.
deal over there. How costly and complex is it to do that?
Most of those deals have free legal services and free valuations associated with them.
So it should be easy to do. So a message to consumers tuned in today would be shop around. You could even switch mortgage provider and get a better deal.
Yep.
Yeah, talk to your mortgage broker. Thank you very much.
Please don't worry about the bell. We will all stay here. Angela. Yeah.
Thank you very much, Chair. Mortgage costs have today risen to the highest level for 15 years, with the average rate on a 2-year fixed mortgage now passing the peak of what happened in the aftermath of the mini budget. The Bank of England say that the rate on new mortgages in this country is much higher than it is in other countries, 4.56%, although I suspect it will be higher now in the UK compared to 3% in France and 3.95% in Germany. Why? Mr. Assam, why?
The way that we price the mortgage product has a number of different components in it. So, for example, costs, operational capital, and then the big drive over recent months has been the external funding costs of the 2-year swap or 5-year swap.
So you're talking about the price of gilts. That's having
Yeah.
a direct effect on why our mortgages are so much more expensive than mortgages you could get in other European countries. Is that a fair point to make?
That is the link, yeah.
That's where the pricing comes from. Does everybody agree with that? Yeah, everyone's nodding. Okay. I want to talk about the buy-to-let sector. Who's giving evidence now? I know, Mr. Terrington, you specialise in the buy-to-let sector, so I'm going to be asking you some specific questions. But does everybody else have a buy-to-let section? Do you all offer it? You all do. Okay, great. What I'm trying to get a handle on now is the pass-through from mortgage interest increases into rental increases for people who happen to be in the rental market. How quickly do you think rate rises on buy-to-let mortgages feed through to rents? Mr. Terrington.
Yeah, I don't think that there is an immediate and direct effect as much as people might think. So if you look, there's about 5.5 million properties in the private rented sector, and if you look, there are 2 million, according to UK Finance, 2 million mortgages on that sector. That only represents 37%. So clearly there are 63% of people who do not have a mortgage. So they are not experiencing an increase in their funding costs. Yeah. Separately, the vast majority of lending into the buy-to-let market is similar to that you've heard elsewhere, is on a fixed rate basis. About 90% of our lending is on a fixed rate basis.
And it's interest only mainly?
It is interest only.
Which makes it more sensitive to, price-wise, to rises in interest
Yes,
rates.
but what we do to compensate that is we have some very strict affordability tests, and we typically lend at low LTVs. So to compensate.
That's for the person that's buying the property using rental income to do so with a mortgage. But if their costs rise, they could very quickly pass those on, the ones that have mortgages, to renters at the end of the 6-month period that the contract lasts. For example, there's been a 5% increase in rent in May, which is the highest increase in 7 years and well ahead of earnings growth. So there is quite a big pass-through, isn't there?
So there is typically a very clear long-term correlation between wage increases and rental inflation. And you can track this back decades to look at it. Obviously, there are leads and lags between that. Things don't always happen in the same year, but that's what typically happens. So I think there was labour market data out this morning. I think where wage inflation is running at around 7.6% in the private sector, a little bit lower in the public sector, and the rental increases there is the ONS data of 5%. Is kind of therefore not really out of line with that general trend in wage inflation.
But rents have gone up 20% in 3 years. Wages haven't gone up 20% in 3 years.
I said there are leads and lags to this. If you look at the experience during COVID, there was experience of rent. Well, but rents declined during that period.
Well, there was regulation on rental increases during COVID. So let's look at the period before that unusual period to look at what's happening. And what we're seeing is a relentless increase in rents, which is exacerbating the cost of living pressures for people who can't get on the housing ladder because the barriers to entry are too high for them. They seem to be suffering higher levels of volatility and increases, particularly in areas where property prices have gone up, such as London.
Yeah. Well, as I said, there is a very clear correlation between wage increases and rents. I think if it is being disturbed at the moment, that relationship, one of the factors behind it is that there is a significant shortage of rental property. Kind of everywhere you go, everywhere you look, you see almost like long queues of tenants looking for a rental property. And the number of landlords that are in the private rented sector today is probably lower than there has been in probably any time since 2015. And one of the reasons for that is that you've seen a period here where the costs of becoming a landlord have gone up, and I don't just mean funding costs, but the kind of the overhead of running a property. In addition to that, there's been fairly significant tax changes that were introduced around the budget of 2015. That bit on the landlords over a number of years. So many are now being taxed largely on the revenue they receive rather than the profit. And in addition to that, there's a 3% stamp duty surcharge, which is a disincentive to buy. So the landlord's costs have gone up, and it has become a less attractive investment as a consequence. So there is a shortage of property in the private rented sector.
Zoopla shows this. They've done an analysis of the rental market, which shows that rental demand, if you compare it to a 5-year average, is up 51%. The stock of homes available for rent is down 33%. The flow of new supply is down 9%, and rental growth, in other words, the cost of renting, is up 11%, which is running very, very well ahead of wage increases, especially for those who are either young workers who have moved away from home but can't afford to get on the housing ladder, and or those who are low paid. To what extent is housing benefit subsidising some of this increase? Has anyone done any analysis of how many renters are relying on housing benefit?
I can respond to that. The housing benefit is certainly, there's a component of the private rented sector which is basically a form of social housing. If you look at the distribution of the types of tenants, there is probably around 20% of the whole of the private rented sector that is in that category. What you have tended to find, though, is that has become less significant in recent years because there's been a freeze on the local authority housing allowance that's available. So it has become a less significant component as a consequence. And if there's one thing that I think it would be useful for perhaps the government to look at, would be to unfreeze that, because
it's just more public subsidy of private renters buying extra properties, isn't it?
I understand that point, but what the issue is that those tenants have to compete with the private sector tenants, and if there's no real council house alternative, then that is their only source. Without kind of changing the whole structure of the private rented sector, there is a direct impact because those social focused tenants find it a struggle to compete with the private sector.
Of course, finally, average rents for new lets rather than average rents overall. Clearly, with volatility and price rises going up, new rentals are going to cost more with the lack of supply that those figures that I've just read out imply. So average rents for new rents have increased by 11.1% in the last 12 months, but earnings have increased by 6.7% and lower in the public sector. So that is putting an enormous squeeze, is it not, on those in the rental sector who
Yes.
have... Yeah.
No, I agree with you. It's running ahead of inflation, it's running ahead of wage growth. But I think, as I said earlier, there is cycles to this. There are leads and lags. What we've seen over the
And you're
last...
expecting it to even out then?
Well, actually, I think if you...
there's not a lead, is there? There's just been rather a long lag.
Yeah, if you look at the rental inflation in the last few months, it hasn't shown much in the way of a step up. So one suspects we might be moving into a point where you start to hit affordability constraints of tenants, and in which case it doesn't matter what you want to think you do as a landlord, there will be no real capacity to increase rents.
But you might then just sell up.
Then
And then you reduce the size of the rental market and still don't help those who can't afford to get on the housing market ladder to have anywhere to live.
I agree. And so the fundamental thing is we need more supply into the sector.
Or more social housing. Thank you
Thank you very much,
Chair.
Angela. Danny.
Chair. I want to dig a little deeper into the structure of the mortgage market, please. And Dame Angela mentioned the high costs of mortgages in the UK compared to some European countries in particular. But as we've also discussed, there's a real difference in the length of mortgages that people have. And it's a helpful graph here showing how much of an outlier the UK is. Only Ireland seems to be comparable in the proportion of mortgages that are very short-term, fixed rate mortgages that are so short-term. I mean, we have only 10% of mortgages of more than 5 years in this country, whereas in other countries, I mean, Poland seems to have 100% variable, Finland well over 90% variable, or at least more than 10 years, and that's a pattern across the continent. Can you just, you mentioned that how little take-up, this is a question for anybody, I'm interested in general thoughts, so just jump in, but it's been observed how little take-up there is, how little demand there seems to be for longer-term mortgages. Can anybody explain to us why we have that syndrome in the UK, whereas in Europe it seems to be a different trend? Who wants to explain? Andrew.
We've been asked this question a number of times around long-term fixed mortgages and why there's no appetite. We survey customers regularly to see whether there would be more appetite, and every time we ask the question, customers come back and tell us about the desire for flexibility and the preference for the shorter-term products. And I think it potentially due to the fact that that would have been the right thing to do over the last 10, 15 years, taking a shorter-term product as interest rates trended down. Now, whether that changes as we move through this cycle, we'll need to wait and see. But the market for 10-year fixes, before we even think about 15 or 20 or 25-year fixes, we think is around 1 or 2%, low single digits. And that's reflected in the feedback we get from customers every time we survey them on what their preferences are for mortgage products.
Any other thoughts? I mean, interest rates have been low around the world in the last 10 years, so does that account for it sufficiently?
No, I think it's a product of the way in which mortgages are funded in the UK. So I did a lot of work on this many years ago, looking at what could be done. And the part of the issue is probably the easiest comparison is the United States, where the market is dominated by long-term fixed rates. And what happens is when you have a mortgage, there is what's called, you have a clog on the equity, as it's called. Sorry, it's a bit of maybe a legalistic phrase, but it basically means that you have a right as the homeowner, you have a right to redeem your mortgage at any time. And
ban on early repayment charges.
Yes, there might be like some compensation there, but what happens in the United States is, let's say you have a 25-year fixed rate mortgage at 3%, and rates then go up. No one redeems their mortgage. They stay where they stay where they are. They might port it to another house, but their mortgage stays where they are. If the inverse was to happen, rates come down from a high level, everyone redeems. So what you then have is who carries that risk? Because as banks and building societies, we want to hedge ourselves to protect that interest rate risk. So what happens in the United States is basically there is a price added. So it's known as the option adjusted spread. It's a couple of percentage points added to the interest rate. Now, if you're offered the opportunity to have a 3-year fixed rate for 5 years or a 25-year fixed rate for 5%, 2% higher, customer demand is such that very, very little take up for the higher interest rate. So it has been tried by a few banks in the past with significant failure to attract any interest on it. But it has, like Andrew has said, it has been looked at on a number of times in the past. And I think the structure of the way mortgages are funded in the UK is the dominant feature.
That's a consequence of regulation. The US has this essential protection against these early repayments. Do you think that's something that we should be considering here? Do you think that would help?
Well, the US, back some, I think 80 years ago, created Fannie Mae and Freddie Mac, which facilitated the ability to create this essentially a government guarantee that sits behind the mortgage, and then the mortgage is then packaged in securities and then traded. So it's traded and looked at equivalent to the US Treasury or the UK gilt. So if you want to create that, then that's another factor, but it's taken them 80 years to get to where they've got to today.
Okay, so just going back to the point that, which is an eminently comprehensible one, which is that consumers have concluded that rates are low and trending downwards over the last 10 years, so why fix yourself for too long? What goes down must come up. We all recognise that, and we're seeing it now, but consumers have been presumably persuaded that rates are going to be low fairly indefinitely. I appreciate that you don't advise households yourselves, but brokers do. So can anybody tell me what they think of the role of the brokers in advising borrowers to stick to the short-term fixed rates? Do you think they have a role in this? Do you think they've been doing their job right over the last 10 years? Bradley?
Yeah, I think brokers fulfil a really important role in the market, and I think what we see at the moment for customers is what's most important to them, and it would depend on their situation. So as an example, if you're a first-time buyer or you're moving property, actually it may be what's the most important thing is how much you can borrow rather than the actual rate that you pay, within reason, of course. And for a customer who's refinancing, coming to the end of their mortgage product and wanting a new product, it's predominantly going to be about price. I think to Andrew's point, what we've seen is historically when there's been 10-year fixes as an example in the market, they've been more expensive than shorter term fixes. And so therefore customer advice has been centred around, well, what's the cheapest for me now? I want certainty for a period in time, but I also want some flexibility, and I want the best deal in the market. So that's primarily driven it. Whether or not, in the future, if long-term fixes were cheaper, then that might drive a different demand, but certainly customer demand currently is for shorter term flexibility.
I recognise. I was thinking about the brokers. I mean, presumably they're incentivised by their own funding model to prioritise, turnover rates of changes, people remortgaging. Do you not think that there's a structural incentive for them to encourage people to take short terms and then remortgage, and that they do better that way?
So in terms of a procuration fee that lenders pay to brokers, it's the same amount irrespective of the length of the product. So there's no incentive they get paid more. I think there's some definite, from an advice guidelines perspective, there are clear guidelines for those customers applied by the regulator to ensure that it's a good customer outcome for that customer and it fits their circumstances for this moment in time. So if that customer needs flexibility or wants flexibility as well as some certainty of payment, then the broker will give that appropriate advice.
Okay. Last question, if I may, to Ms Harrison. I think you said that you were offering 10 years, but not at the moment. Is that right? Is there any other reason other than just you don't see the demand for it? Is there any reason in your business that you shouldn't be offering a longer term deals than you are currently? Purely, customers are not asking for it.
It's demand led. We don't see the take up, and equally, I think with peaks and troughs in terms of rate cycles and what that could look like, customers, as Bradley's just said, that actively are choosing against that. They want the cheapest deal available to them. So it is demand driven.
Okay. So it's not your own fear of volatility in rates, future rates, that mean that you're keeping to short term?
No, because with our fixed rate pricing, we hedge against the interest rate risk. And that's hence the cost in terms of fixed rate mortgages.
Yeah. Okay, great. Thank you all.
Thanks. Did anyone have any other questions? Angela?
Yes, thank you, Chair. I just wanted to come back to Mr Tarrington. You were saying that a majority of people who rent, who own rental properties, don't have a mortgage on those properties. But of course, they probably put the rents up at the same rate as those who do have a mortgage on the properties, since there's a market there. So they're making a lot of money without having extra costs, aren't they?
They're all subjected to the same more general cost increases, so whether they have a mortgage or they don't. But again, I come back to that point. There is a significant shortage of supply of properties into the sector, and in many places it's acute. The student market is a particular area that we should be concerned about, because there's clearly a regular supply of students coming through year in, year out, and there is a bed shortfall, as it's measured, of something in the order of a couple of 100,000. And, it just becomes so acute that, we have heard talk of some universities reducing the intake in order to cope with the accommodation problems. Though I do genuinely think that there is a supply issue into the private rented sector, driven by a number of facets, which I highlighted earlier. But it's a bit like any other industry. The reading now about the cost of aviation. The cost of going on holiday is going up dramatically because there's a shortage of flights and staff to be able to deal with it. The hotel industry having the same problems. The restaurant industry closing on certain days because they don't have the availability of the supply chain has been disrupted in a number of markets and still exists, and it's happening in the private rented sector.
Thank you. Douglas?
Just one final question from me. Just what are your economists telling you about the longevity of higher interest rates and whether this is going to have a long-lasting impact on the UK economy? Because it seems to me that where we are looking out to maybe 24 months or something like that and hoping that all will go well, but there's no guarantee that that could be the case. We could be in this cycle for a good number of years. So are there any projections that you guys are picking up that we as a committee should be concerned about in terms of our linkages with the Treasury? Henry?
So I think the market implied view would be that base rate gets to about 6.5% and then reduces down to maybe just under 4% over the next couple of years. So that would feel like it doesn't lead to a long-term impact of high interest rates. I'd say there's a lot of uncertainty though around exactly what path interest rates will follow going forward.
Any outliers on that? Or you're following the party line as regards the outlook for the economy? If that's...
Yeah, that's what our projections look like as well, that base rate will rise towards the end, up to the end of the year, and then over the longer term potentially will fall back moderately. We're not expecting that it will go back to what we've seen in 2021, 2022 in immediate future.
Thank you. Nigel, did you want to add
Yeah.
something?
Yes,
Yeah.
just one additional point is that, the market is expecting interest rates to rise further from here, stay up at that level and then come down. If you look at the swap market as an indicator for that, the 5-year fixed rate today, and then look at the market's estimate of what the 5-year fixed rate will be in 5 years' time. I'm sorry, it gets a little technical in parts here, but that's actually suggesting that rates will be 1.75% lower in 5 years' time than they are today. So that indicates that up, across and down movement. It's just a question of, which is the view of the economists. They've all got the central thesis here, but the issue is to whether it's overdone. When I look at some of the data, I look at the PPI data, the producer price index, which has fallen rapidly, but the consumer price index is struggling to fall. But it usually does, it just lags. And so it would then play into the expectations of maybe, and the hope of the governor and the Treasury, that the inflation figures will come down quite sharply from here. I think if that does, and I think the market has become quite sceptical of believing whether this will happen, but if that does, then I think the market will start to look at it's overdoing the interest rate expectations. But that has to happen because it clearly hasn't happened yet. But if it follows the path of PPI converting into CPI, then that is inevitable, but it's the kind of second half of this year and more into next.
Thank you. Anne-Marie, and then I think Andrea. Anne-Marie.
Thank you. Mr. Terrington, buy-to-let, I think what you say consistently in answer to our questions is the problem is the market is shrinking, and therefore we don't have enough properties effectively available to rent, consequence of which is inevitably rent goes up. What might the government do differently? Do you think it was a bit of an own goal to change the tax regime so that those in that sector, as landlords, are effectively paying now, not on profit but on turnover? Do you think if there was a change there, that would make a difference, given that we can't suddenly create the new houses and build them overnight, which clearly would be a much more socially acceptable answer? Would that be a way forward? And what do you think the impact of the Renters Reform Bill has been on this market?
Okay, so the first thing about the tax changes, they came in. They were announced in 2015 and then were phased in over a number of years. And I think for some landlords, it has the effect, as I think I said earlier, of being taxed on revenue, not profit. And the consequence of that is that despite the fact that you could have a kind of a theoretical profit, you're actually paying more tax than you are earning, which is a strange situation for people to be in. I also think the 3% stamp duty surcharge acts as a disincentive. So both of these are disincentives, and they compound with the additional costs that have come into the sector. I'm less concerned because I think it's good that the standards in the sector are lifted. We all support the raising of standards in the private rented sector, and we've been very supportive of the Renters Reform Bill. In fact, we did engage with the Department of Levelling Up as that was being converted into a bill. On that, I think that, as I said, we're very supportive. We're supportive of the changes to Section 21, Clause 8. There's two things in there that we think we are still concerned about. One is on the court process. If you want to sort of go through an eviction process, you have to go now under the bill, go to court. The government have promised that they will change the court process to deal with this, but we already know that the court process is already quite full, and I'm therefore nervous that whether there will be enough capacity and to ensure that it won't overload the court process and you end up with massive problems that happen as a consequence. The second is actually going back to the student market. At the moment, if any of you have gone through the process of having a child at university, they want to book up the following year's residence a long way in advance, up to a year in advance. And for a landlord, that's great because they then get a commitment 12 months forward. Under the current bill, for the Renters Reform Bill, it means that the current tenants only have to give 2 months' notice. And if that's 2 months before the end of the final term, so maybe April, May, then that's not long enough for a landlord to find a tenant for the following year, and in which case they can't market their property as being available, so they might find themselves as being without a tenant, and then suddenly there's almost like a free-for-all for students trying to find property right at the end of the term. So we have discussed it with them. They have acknowledged that this may need to be reconsidered, but it's a very real issue that needs to be resolved before it converts into an act.
Thank you, Anne-Marie. Andrea.
Yes, thank you. Just coming back to consumers once more. In a previous hearing, Charlie Bean said to us that he thought that the idea that the pain of rising interest rates would be taking a longer time to come through because so many people are on fixed rate mortgages now. He had a slightly alternative view, which was that in fact people will plan ahead, so it will affect, even if your fixed rate mortgage doesn't expire for 2-3 years hence, it will still affect your day-to-day spending. I know you said, Mr. Assam, that you're actually contacting customers 6 months before their mortgage ends, but I just wonder if any of you have a view on that. Is he right? Are you already seeing changes in behaviour, or are people going to think, well, I just really hope that interest rates will come down?
I think I'll answer some of that. I think it's difficult to know and to predict the future, but I think that what we're seeing anecdotally is customers overpaying, more overpaying, so already starting to look forward and think, actually my deal is coming up in maybe 12 months time. It would be better for me if I have, you know, some savings to be able to pay down my mortgage. So we're definitely seeing that. I think the conversations we're having with customers, or we know that the conversations we're having with customers are thinking about that. So, you know, we talk about how the customers ask, they've got 2 years left on their deal, what's their options? I think customers are thinking. I'm not sure we've yet got the evidence to see what they're acting on, but I think customers are definitely thinking about that. We're having those conversations. Customers are concerned about what borrowing costs might be in the future.
Thank you very much, and thanks to our witnesses. It's been a very interesting session, and I know there's a high level of interest from our constituents in the evidence that you've given today, and I think it's fair to say that all of us MPs, you know, in addition to our register of interests, you know, a lot of us are paying mortgages, and I just wondered if any of my colleagues after today's evidence session feel that going beyond the register of interest, there anything that they want to draw attention to in their evidence and make any statements about any interest they may have.
Well, just for the record, I have a mortgage with my husband, and my husband and adult children have a small buy-to-let business.
No, I have a 5-year
I
fix.
have a mortgage and I have a buy-to-let mortgage.
Yeah. So as you can see, it's something that really touches on so many people. We've been very grateful for your evidence today. I think one of the things that surprised me about your evidence is that you do sound quite calm about the quality of your book of mortgages and how your customers are really prioritising everything in terms of making sure that they pay their mortgages, and that you're not seeing a particularly marked spike in arrears. So it's been a very interesting and timely session. We're very appreciative to you all for your time, and at this point I'm going to say order. That concludes this Treasury Committee session. Thank you.